I used to be cool.
Yeah.
Well, hello, and welcome to the Retireable Podcast. I'm Mike Wallace,
And I'm John Sauger.
and you're looking very distinguished today, John, with your glasses, huh?
I feel we're more focused on this meeting. This is a really important one.
So if they're listening to this podcast, they can see your glasses, right?
Absolutely. They can understand that I am ready to go. They can probably hear it in my voice, more of a smooth voice, ready to talk about.
Are we doing smooth jazz today, John?
No, we're talking about private equity.
Oh, private equity. That's going to be what we're talking about. Okay,
Absolutely.
that's fantastic. Yeah. But before we do that, we should probably talk a little bit about other stuff.
Okay,
right?
take the glasses off to talk about other stuff.
Okay.
Yeah.
So yeah, because you couldn't wear that on the roller coaster down at
Down at Universal Studios?
yeah, because those would have fell off.
They wouldn't allow you to take them on. That was
Yeah.
so quick backstory. We were at a workshop and down in Florida earlier this year in January 2026. We were down there. Had some nice warm weather. That was
Yeah.
great. Right, 80s. So we had a couple of hours where the workshop we were at was allowed us into Universal Studios, where essentially the Universal Studios was closed, and we had a private spot. So we did a handful of different rides, but one of the rides was the Jurassic Park Velocicoaster, I think is what it was. Yeah. So Michael and his son David and myself and our friend Mike's teammate Jake, the four of us. We had a few other people with us, my wife and our friend Mark, and they didn't want to go on it. So the four of us went to get on the ride. Now, as we went to get on the ride, there was no lines, and because the park was closed. And so we were racing through the line, and we got to a point, if you've never been on this ride, we got to a point where it was a hard stop, and you had security there that you had to go through security to get on the ride. And they told you they had lockers there for you. They told you take everything out of your pockets, take everything out, all the different components, and then you had to literally walk through a metal detector.
Yeah, no phones, no glasses, nothing. Like everything was.
So they said that.
Yes.
You decided to try and sneak through because you at first went, I have a zipper for my phone that works.
Yeah, I have my cargo pants.
Yes,
You're right.
and
I was like, I don't need to put my phone in there. I have that.
I'm going to put all my stuff in there. But then when you went through the metal detector, they're like, no.
I forgot about that.
Yes.
Yeah, that's funny.
Yeah. Michael wears glasses and as you can see if you're watching on the video, they did not allow even your glasses to go.
No, they would have fell off. It was that rough of a ride. So yeah, I understand that. Remember though, when you were a kid, you had that little plastic like a rubber band around you when you did that when you played sports. You don't keep your glasses on.
Honestly, I have those now for my sunglasses when you're on the lake. Yeah, I have some of those. Yeah, there's different versions of them, but I have some of those.
I used to be cool.
Yeah. The crazy thing though about that ride, if you've never been on that ride, look it up and you watch it on YouTube and see what it is. It is a aggressive roller coaster. It was a lot. It was really, really cool. There were a couple of points where you were literally weightless. It was awesome. We looked it up online. There's like over 100-foot long distance where you're upside down.
Really?
Yes.
Okay.
Yes. It was a heck of a thing. But yeah, you were not allowed to take glasses. You were not allowed to take anything on there.
No, it's something I couldn't pass up, but I literally thought I retired from roller coasters because as a 50-plus-year-old man, I didn't want to hurt my back or all this other stuff, but I just had to try it again. I hadn't been on a roller coaster for several years, so wow, and we did all of it. We did Harry Potter.
We did the Hagrid's motorbike, the Harry Potter castle. Yeah, we did everything. It was
so fun. And it was just nice being in Florida. Spent some time with obviously some of my coworkers and some family. And you actually one of your daughter joined it.
My middle daughter and her husband were able to get down there because he had a convention the following week that we were down there. So we stayed longer through the weekend and we went to the Disney parks and went on all the rides. We had a great time. It was really good. I missed the other kids, but on the other side, it was really cool to have just some focus time with one of the kids and stuff. So it was nice.
No, it's nice. I got a couple rounds of golf in, so that's always fun in the winter time because it doesn't happen. Obviously, we were terrible, but it's all good.
My daughter was pretty straightforward. It was like, okay, well, are you worried about getting some sun or whatnot? She's like, I'm fine being in the sun, but on the other side of the coin, I'm not trying to get a sun tan. because a lot of times they, she's younger, and you talk about a little Chinese. It's like, why am I worried about getting a suntan? It'll be gone in a couple, because we're not getting that sun back in Michigan, that. So yeah, it was kind of fun, but still a great time.
Oh my gosh, it's hard. Well, it's hard not to have fun in Florida in the winter, but we lucked out in the weather because it
Sure.
was, like you said, 70s and 80s, and just the following week,
The last day we were there was when the weather changed. We were there on Sunday, and the weather changed. We were this is and Sunday. This is really interesting. Was the Disney marathon. So we were at one of the Disney parks. We were at Epcot, and that's where they finished. So it was really cool watching these people finish. I did not know you can run 26.2 miles. That's a marathon. The parks are open when they're running. So if they're fast enough, they're allowed to go on rides. Isn't that crazy? So like a marathoner, you're expecting them to finish in a certain time. This is not that type of marathon. It's like you're 8 hours in and they're still running because they jumped on different rides. It was really crazy.
That's the wildest thing I've ever heard.
That's part of the reason, I guess, why people do it, is they're like, oh, I want to get on this ride and this ride and this ride this time. Last year I was able to get on this ride, this ride. That was pretty crazy.
I never heard of that.
Yeah.
Do they have to stand in the lines, or are they able to
No,
go?
they have to stand in the lines.
Okay.
Yeah, there was two gals when we were at Epcot, two ladies that got out of line, and the one of the Disney workers that, like, they they're monitoring the line, was like, you can't ride that ride. You do not have time before the marathon is over. You will not have time to stand in that line.
Okay.
And they were like, oh no, we're just getting coffee. They were standing in line to get coffee 26 miles in. Yeah, that was pretty cool to see. But going back to the weather, it was almost 80 degrees that morning while they were 70s while they were running, and then rain hit, and it never got above 60 the rest of the day.
Yeah.
It was freezing, at that point. But
we've all been to Florida when the weather hasn't cooperated either,
Yes.
especially northern Florida like that. You just don't know what you're going to get. If you go down to Miami, you're going to be okay, but maybe Tampa or Orlando or the Panhandle.
Yeah.
I've been there, and 40s and raining before. Like, God dang it, why am I in Florida?
Yeah. Why did I not wear a jacket? I'm wearing shorts. It's crazy.
That's crazy. Well, so we're going to talk a little bit today, but John got to get the glasses on now, because we're going to talk about some sophisticated stuff today.
Okay, very sophisticated.
So we're going to talk a little bit about what they call private equity.
My pinky out.
Yeah, there you go. You got your pinky out there? Yeah.
Talking about private equity.
So oftentimes we don't like to get too much in the weeds in certain subjects, but this has just been more topical the last few years. And one of the biggest reasons, and we'll kind of define what private equity is a little bit more in a minute, but part of the biggest reason, though, is that the actual, if you statistically, the number of public companies are actually diminishing. They're not. We used to have a lot of growth, a lot of IPOs, and so a lot of this has to do with private equity. So, John, why don't you kind of give us just a general definition of what private equity might be?
So private equity is essentially where a company, an investment style company, will raise funds to purchase something that is privately held. So if you think of publicly traded companies versus privately traded companies, or private companies, a publicly traded company might be something like Coca-Cola or Pepsi-Cola or whatnot. They follow certain protocol. You can buy their stock. You can see who their shareholders are. You can see what their earnings or their expenses. Very public. There's laws and documents and requirements to file and follow. A private company doesn't necessarily have to do that, right? And there are many, like you said, there are more and more private companies out there. But private companies right now are very popular because they don't have to follow as much protocol. But now with private equity, they can raise money, and you could be a part of that. So think, for example, everybody always talks about, boy, I would have loved to have that one company or whatnot. Years ago, not picking on companies, but just naming, years ago, a lot of these companies started out private, right? Uber was a private company, and everybody knew, wow, this is a great idea. I'd love to be a part of this. Well, you couldn't buy into it unless you were able to get into private equity or venture capital, which is a totally different world. But for private equity now, Uber, Airbnb, some of those companies there's many of them now, like the artificial intelligence companies that are private equity based. So.
Yeah. Well, and a lot of times too, I mean, kind of the purpose of this stuff, and when we first got in this business many years ago, they had versions of this.
Sure.
They are more, maybe over the years you might have part of like a limited partnership, or alternative investment, or real estate investment trust.
Sure.
Kind of. So it's kind of more of an evolution of this. Okay, but what happens is that the most of the time with the private equity, it's more of a strategy to get in and get out and raise
Sure.
money, and of course it's for the profits
Sure.
themselves, right?
Sure. Well,
So
and they're wanting to. A lot of times, it used to be in the old days, you wanted to get in before the company went public, and everybody else could buy in. So now you had the shares that everybody was buying from you when it went public. That was the original back in the day. Why people wanted it so much.
yeah, so a lot of these are designed to have exit strategies,
Sure.
and so sometimes it's over a longer period of time though too. So when we're dealing with a lot of the private equity, most private equity is owned by institutions, not by individual investors. Okay, why? Well, first of all, most institutions have more money, but most of the time because a lot of these investments are illiquid. You can't they're not openly traded, not like a stock where you can buy and sell it, right? Where a lot of these things are now, they may have a 10-year strategy or a 15-year strategy, but you also, so they may try to do that. And you've heard of different things like venture capital, for example, where it's more early age startups. But a lot of these now, sometimes they're taking public firms and making them private, even.
Well, and the premise behind it from the company's perspective is it's a way to take in more assets, right? To raise capital or take a component of it. There's a lot of different ways that you're seeing it, though. There are companies that might need funding. We're doing it more in research and development. We're growing our company. We're expanding and we want that funding. So that's one way. The other way, though, is there are places that are just doing it as a profit component, right? You might see a company that's like, we're privately held and we're doing very, very well, but someone's willing to give us a couple $1 billion for a minority stake. We'll take that payment, right? So we see some private equity that way. That's a component where you'll see people that might look at it as an outside investor, go, I can buy into something and own a fractional share of a Formula One team or, Green Bay Packers or something like
Yeah.
that, right? So there are things that people, it's just, there's a component on it where companies are taking some money for help and research and development. That's one way. The other way is just, hey, we want to offer this as a profit component. And other people like to get into it and say, hey, yeah, I own part of I don't know, Buffalo Bills, right? So just that component of it where you see it.
Well, and so, with the internal driver, a lot of it is profits, right? Like we're trying to make money, and oftentimes it's going to try to be significant returns if we can, right? So in the traditional marketplace, maybe in a traditional stock and bond mutual fund or managed account, I should say, more ETFs, et cetera. Yeah, obviously, unless you buy the individual stock, like some of these Apples and Amazons at the right time, and then obviously hold it, you can do very, very well. But the issue is most of the time when you're in that, you're only expecting a certain internal rate of return over a period of time. Okay, so
Well, in comparison, just so as we're talking about this, if you're looking in January of 2026, there's a lot of points where there's a lot of investments that you could buy into, in indexes in the market or individual holdings that are at their 52-week high or at their all-time high. And you're looking at it going, boy, I think it can go all-time higher, but what's your rate of return on that? Well, if you're looking saying, boy, I'd like to get something that has a bigger rate of return, private equity might be a spot where I'm going, hey, I'm buying into something that's a newer company. They might be able to get a significant growth, or buying into something that's a privately held company that might get a significant growth. So that's why we see people looking at the private equity from the investor side. It's a rate of return potential.
well, and a lot of it used to be where, you have to be more of an accredited investor, so you have to have certain net worth, or certain income to even, and the minimums were a lot higher than they are now. We'll
Yes,
talk about
yes.
that in a few minutes, where it's now with technology has been able to be brought down a lot more for the common investor. But the premise behind it before is, it's high risk, high reward.
Yep.
Okay. And so a lot of the millionaires, billionaires, with the over the years, they, so what? If they put $10 million in investment and they lost it, they didn't really care because they had $5 billion, right? And so, but if you only have, $10 million and put $1 million in there, you lose it. That's a significant portion of your
Absolutely.
assets.
Absolutely.
And so now it's just evolved over the years when we're dealing with some of that stuff.
Well, and just so you're aware why it's evolved or where it's evolved, that just values and numbers have changed dramatically. You talked about companies not having as many, in the mid 2000s, so like 2010s ish. a term became popular. And I've talked about this on this before. So if you've listened to all 4 seasons, you might have gotten this. But as we're in our 4th season, to save you the time, there's something called a unicorn company. And a unicorn company is a company that is privately held but believed to have a market capitalization or a worth of $1 billion or more. Right. And in that situation, back in the early 2010s or so, the unicorn companies, there was 10, 11 of them. Like it was defined, but there weren't a lot. And you can think of those names of companies that if I say to you now, you go, oh my gosh, yeah. Well, Airbnb, right? How many people have used Airbnb nowadays? Uber, I used that as an example before. Those were privately held companies at the time that were supposedly worth more than $1 billion. Now, back then, people go, wow, that's a lot of money. Are they really worth that? Well, since 2023, there are over 100 companies that have started since 2023, not before then. They started in 2023, and they're believed to be worth more than $1 billion privately held now. Now, most of those are based on AI, but 100 companies, that's where private equity is going, wait a minute. There's all these companies out there that are supposedly worth $1 billion. How do we capture some of that potential for growth?
Well, and not only that, that's a really good point. So people right now are wanting to, they want to invest in AI. And again, there's some of these larger companies that are invested in that AI space, but they say they're privately held. So how am I going to capitalize as an individual investor on some of these innovations? Well, a lot of times, to get it from the ground up, that's where you have to be is these private equities. And more importantly, a lot of these big companies like these publicly held companies, they put a lot of their money too
Yeah,
in these
yeah,
companies,
yeah.
and sometimes they're buying the whole company, and sometimes they're buying pieces of it because they want to profit from some of this stuff too.
The and the crazy thing, if you look up, kind of as we're looking at this, and you look at just the names of companies or the number of companies that have that valuation, that have that growth, that have that, it's stunning how many are out there, and how many are looking from the business perspective to say, sure, if you're a company coming in that wants to give us, $100 million, we'll give you fractional ownership. We'll take that cash infusion and use it for whatever they want to use it for, right? There is a level of risk there. We understand that. There's a component there. So you're not just dumping it in to go, oh, Bob Smith is a privately held company. Let's give Bob I mean, it's not necessarily that, but it's looking, saying, okay, this is a company that is building, growing, whatever, that has a track record that we'll look to get into. From the diversification point, from the growth point, all these different reasons of it, why it's though something that we talk about with families is from the other side, you're not putting your first dollars into private equity, right? You're not saying, hey, I have $100,000 and I want to put $99,000 into private equity. It's not necessarily what it's designed for.
Yeah.
It's a different amount or percentage. But if you're sitting in retirement saying, boy, I'm considered high net worth. I got 2 million in my IRA. I got 3 million in my IRA. I got 4. This might be a portion where we say, you know what, we're not just dumping everything into X, Y, we're going to look for a little bit in this regard. So it's going to be a small, a percentage. It's not going to be all of your money, like you said, because of the illiquidity, right? But that percentage, again, we have a client who's like, yeah, I own a fractional share of an F1 Formula One racing. He's a retired engineer. He watches Formula One. He knows what he's ecstatic with that, and so that portion, he may make money or lose money. It's not going to bankrupt him. It's not going to change his life, but he loves it, and it gets him involved in his retirement to say, "Hey, how's everything else going?" So it's a tool as well in that regard.
Oh, yeah, absolutely. And the thing is, it's again, it's evolved and changed. We heard about Silicon Valley, for years, right? And that's where a lot of those big companies that some of the largest companies in the world right now have evolved from. And so, and there, you hear startups, and you have these companies that do a lot of that stuff. And obviously, it's still there. I'm not saying that it's not using it, but now there are companies that are just raising money to now, and pooling money to find that next company, and before it might have been millions of dollars, now it's or hundreds of millions of dollars, now it's billions and billions of dollars. So I think I read some statistic, something about $3.6 trillion now invested in private equity. So it's really kind of amazing. But but who's utilizing that stuff? So a lot of it is institutions. When I say some institutions, a lot of it are funds and insurance companies and banks and those types of institutions. A lot of it's corporate because they need income and they also need growth, right? For them to be profit, right?
Right.
And so they have to be profitable so they can use that. But a lot of it that people don't realize too are endowments. There's these universities out there, both
Yes.
private and public universities, that have billions and billions of dollars where they of course, what are they trying to do? They're trying to make more money with that stuff.
Sure.
And so they do have, and they also have the time horizon. Because again, some of these have been around for not even, decades, but 100 years plus, right?
Yeah.
And so now we're trying to utilize that kind of stuff too. So, um, so when we look at that then too, what would be like the risk of private equity, John?
Well, again, there's going to be various levels of it, right? If you look at what are some of the most profitable or most successful, if you're looking at private equity and you're saying I'm getting it to some of the more, some of the I don't want to necessarily say high end. I don't know if that's the right term, but if you look at it, I'm gonna give you a couple of example companies that at the time. So this chart is from 2022,
Okay.
right? So it's older, but here's in the top 10. Here's a handful of companies that people are going to recognize: SpaceX, Canva, Instacart, Stripe. These are big companies that do a lot of different things. And so you might say, we're private equity and we're getting into to Instacart checkout program. Well, my gosh, if it's used everywhere, you're going, well, I don't have that much risk because of the usage of it. And so maybe that's a way you look at it. But there is still risk there because it's still a private company. You don't know certain things. But if you're going, oh, I'm getting it to that, I have a fractional share there, but I also have a massive share in Bob Smith's trucking company, you might have a huge level of risk. So part of it is depending on what type of private equity you're using to what your exposure level is. Again, public companies, we know almost everything about them. They're reporting certain things. There's reporting. We're in earnings seasons, right? Earnings season right now as we're talking. We're getting reports on how did companies do. General Motors, Ford, Daimler, or Stellantis, right? We're hearing what's their profit, there's an earnings call where they talk through everything. Private equity doesn't have to do that.
And it's regulated by the government. They have to have certain reporting requirements.
Correct. Private equity doesn't have to do that, right? So
which can be good and can be bad,
yeah,
right?
Again, and I'm not picking on them, right? I don't want to pick on companies, but SpaceX probably has near universal name recognition. That almost everybody's heard of that, right? Doesn't necessarily mean they're making money or not making money, but pretty much everybody's heard of that, right? In that situation. So there is a part where you look and go, oh boy, I'd love to get in some money into that one, right? I'd love to get into that. There is a level of risk. And risk, we're defining it as you could lose money up to all of your investments, right? So there's a level of risk there of saying, boy, I need to make sure I know what's going on and what's there. On the other side of it, there is a level of opportunity that's there as well, right? If you have a fractional share in a company, and again, I'm not picking on them, I'm just stating them. That is extremely profitable and doing really, really well. And you're an early adopter into that program, you could make a significant amount of money. It's all relative in what you're using it for and how you're using it.
Yeah, I mean, the hardest part is, if you're an individual investor, it's kind of like if you were picking your own stocks, right? And not trying to do it equally, but the bottom line is, if you're trying to pick and you can invest, X number of dollars into, unless you're trying to be, highly concentrated in a certain number of stocks, you could be very successful with it. But like you said, a lot of these are at all-time high right now. So how do you make that profit? Or when you're buying a stock, when you buy a stock, at let's say, $50, you go to 100, and that's doubling your money. But then if you're at $500 share stock, and they're not, a lot of the stocks right now aren't doing the reverse stock splits and things like that. So you're in smaller amounts. So literally now I have to go from 500 to 1,000, for that same thing. So there's the profit is a little bit harder, but you also, the odds of it going down from 500 to zero, it might be a little different there. So a lot of it is literally high risk and high reward. Why is that hard for an individual investor? Because if you're an institution, you can buy 10, 15, 20 of those types of positions,
Yeah.
and you only need one or two to hit,
And again, there are individuals and companies that are literally venture capitalists. You mentioned that term before. A venture capitalist is looking for these. That's literally what they're built on. They're literally designed to for that very reason. So they're going to look, like you said, they're going to invest. Hey, here's 25 different companies we know we're investing in, but we've based the number based on we know, 4 of them are going to hit, the other 21 or not, but we're not overweighted. We're expecting to lose money on the 21 because the 4 that hit, we're expecting to make the huge profit, right? So there is a component of that, but that is not necessarily what we're talking about when we're talking about private equity.
Yeah.
If you're a venture capitalist, you're more than likely doing things differently than listening to this podcast at this time, right? So more than likely, again, we use this in other episodes. Most of the people we're talking with, most of the people that are listening to this are really great savers. And private equity is a spot where you can have a percentage to say, can we at the margin push your return a little higher? Can we do something, where we can get something that might be exciting for you to watch, might be something, neat to see. That's what we're looking
And
at.
the good news is it has evolved where now individual investors can invest in these things, and sometimes it is in lower denominations, or they now have companies that are designed that are publicly traded that buy private firms that are private equity.
Absolutely.
And so now the individual investors, in fact, a lot of the portfolios that we use, they maybe have a small percentage in some of these private equity. So what happens is now you as an individual investor, if you want to, you can find what you're looking for. And we never would recommend probably more than 5%, maybe 10% of the size of your portfolio in private equity. But if it's a small percentage of that, and you can get, you can boost up that internal rate of return by utilizing some of these strategies, and it's becoming more and more common. And again, John and I do a lot of research. We go to a lot of these, maybe not as lot of research ourselves as much as we do a lot of go to a lot of conferences and learn about our industry. And that has been something that's probably been one of the fastest growing, at least in the last couple of years, of where now these institutions are saying, okay, now we're building funds, okay, or exchange traded funds that are openly traded. So if I own this portion of this private equity, even though this private equity is looking to leverage themselves, let's say 10 years down the road, but I can say I don't want my share anymore. My $25,000 I'm invested in there right now, I want to sell that. Well, then someone's there willing to buy it now because it's openly traded. Now, I'm giving you simple terms of that. But literally some of these funds are well diversified as well. So they may own, like you said, a little bit of the Buffalo Bills or the Denver Broncos, but they may, they have a part of that might be, private drilling for oil companies, or they may have a subdivision somewhere, or a shopping mall. There's lots of different things, or they're trying to find the next drug that they're trying to find too. And so you're biomedical, so you're dealing with companies, and some of them may just concentrate on certain things, but there are companies now that are now utilizing that. And so first of all, your risk exposure may not be quite as high. Second of all, they're not illiquid when it comes down to that.
Right.
Okay. And that's kind of the issues too, what we've seen over the years, because, a lot of it's just dependent on the marketplace itself. And so, sometimes we've seen some that have an exit strategy for 5 years and it takes them 15, and we see some that have a 10-year exit strategy and they do it in 7. You just don't know when you're dealing with some of that stuff.
Well, in this situation though, the where you're looking at it, why we're talking about it, because it sounds like we're saying there's great ideas, and then on the other side of the coin, we're scaring you on some of those ideas. Again, it's time and place, right? It's percentage of what you're doing. You said 5% of a portfolio. Uh, um, you we've seen it maybe, you've seen it as low as 1% or fractional share. You've seen some people maybe go as high as 10%, but again, it would be relatively speaking of how much it's there, right? If you have $100 million, 10% is, you still have a lot of give and take on 90 million of liquidity that you can access, right? If you have $1 million, 5% is still, a sizable chunk, right? So it depends on how you're doing that on that percentage, but it is there is growth potential there. There is potential for there is, like any investment, it's not perfectly guaranteed. It's not perfectly it's there's risks associated with it. If you understand those underlying ones and you look at it and say, I'm looking for this opportunity in this portion of my portfolio, then this might be something that fits for people.
Well, and I think that's important, John, is that we're not recommending private equity right now. Or, what I mean by that is, if you're listening to this podcast, we're not saying, "Oh, go out and buy private equity." We have to use our disclosures when we're dealing with that. It can be a right fit for some individuals. It is not something that all of our clients that are coming in here to our office that we're going out and buying right now and utilizing. But it's like anything else. It's a tool. And for some people, it might be a right tool for a portion of your assets. But a lot of it too is you have to feel comfortable. You have to be able to stomach some of that stuff as well, and what you're looking for when it comes down to that. So it's just utilizing. And what I really like about it more than anything else is that there are now institutions out there that are now bringing this, and of course the technology too. That's probably played a big
Sure.
role in
I mean,
that,
it is.
because
Yeah.
that now individuals, if that's something that you are interested in, that we can utilize. And obviously, if it can bring up the internal return of your entire portfolio, that's awesome. The biggest concern we have is too many people whatever that may be are trying to, they like to get rich quick schemes.
Yeah.
They're
Yeah.
are trying to utilize these tools and trying to guess right, and so that and granted, we're all want that to happen. But unfortunately, over the years, we've seen it too as well. For every one that we've seen, massive increases. We've probably seen two or three of them that have, you know,
For sure.
been terrible, I guess.
Well,
So, when it comes down to that.
and again, you're looking at where does it fit for you?
Yeah.
What does it fit in that situation? It's why we're bringing it up in this workshop, or in this episode. Why we're bringing it up in this podcast. Like Mike said, we're not recommending it. We're not recommending it. We're bringing it up because it's something that you're going to hear more and more. If you're in Michigan and you are a sports fan, you have probably heard the term private equity when it comes to the Big Ten.
Yeah.
That has been a recent conversation as far as private equity investments trying to buy a fractional share of the Big Ten conference, right? So you're hearing that term. So we want this to be a good source where you can go, well, what the heck is it? What is going on with it? So in that regard, so keeping that component in mind.
All right, so I think that's a good time to wrap that up. And again, we could spend a lot of time getting really into the weeds with this one. But I just want to give it more of an overview and look at it that way. So let's talk about our holistic happening. So we spend time kind of the last segment of our podcast here, just things we run into, but more on a holistic level. When I say that, it might be investments that we talked about just today, might be about tax planning, it might be estate planning, it might be sometimes it's just more methods of what people are trying to accomplish too. But John, what have you ran into in your holistic with your clients recently?
So quick backstory. I have a family that when I first met them, literally 10 minutes after I met him, he said, if we give you our money, I want to buy a Corvette. And he wanted a midage and Corvette. And so as we've been working for a number of years together and working and organizing, they just never felt comfortable doing it. Just never really pulled the trigger. Well, they've had some changes in their investments lately. They had some inheritance and we've had some growth. We've had some stuff where it was like, the wife is still antsy, but the husband is like, if not now, when?
Yeah.
I want to do this. And so as we worked through it, what's very interesting is so on my team, I have kind of a holistic planning specialist. I have Anthony LaRock, who has a lot of background on a lot of different types of stuff. And Anthony has a huge background in the automotive industry, more particularly not so much the automotive side, but cars and car sales. And so, as we were talking through stuff, I connected them with Anthony, and so they talked through what's the best option. Is it to buy? Is it to lease? Is it to whatever? And so they ultimately decided to lease. And the conversation was, at their age, it's hard getting in and it's hard getting out of that vehicle. And after a 3-year lease, they're more than likely going to be old enough where they're not going to be feeling getting in and out of the vehicle, and so they don't want to have to deal with the wholesale and whatnot. But what's super exciting is we were able to organize the funds and get them comfortable and get everything. And I just got pictures the other day. The wife had called and said, he's picking it up on Friday. And I said, well, you better send me pictures. And so I got pictures of him sitting. Now, we're in Michigan in January. He had to drive it home in the snow.
Oh, geez.
It was very antsy.
Yeah, yeah.
Okay? But got it home, got it in the garage, got it cleaned up, got it all set, got everything, and just smile from ear to ear. Now, we talked about from the holistic side all the components of how are they affording it, what's the insurance situation, where's the money coming from to pay for it, all those different things that really matter. But it's really a cool story to see it. It's a beautiful car, it's exciting, they're super happy, and so from a holistic planning side, that's the cool things as far as they knew one conversation with us, we could talk about all those different things, and so that was really cool.
Well, I think one of the coolest things about what we do too is that we do a lot of goal setting for individuals, and again, people have different goals and what's more important to them, and sometimes whether it's a vacation home or whether whether it's a car like that, or whether it sometimes it's very simple, and so but they're thinking it's really more complicated than it may be.
Because they're doing it themselves. They haven't seen it the hundreds of times we've seen it and talked about it, for sure.
So it's just nice to be able to put a pen to paper. Of course, the technology won't be used more than the pen to paper, but that they can now accomplish and do what they want to do. And
Absolutely.
that's one of the things I love about my job.
Well, the other thing that's really cool is that you have a good enough relationship where they will share their excitement for it. Hey, here's where we are and the excitement of it. It was really cool to see because it was the smiles, like they were just ear to ear. He was just had the biggest smile on his face, and I could hear her. One of them was a video, and I could just hear her laughing the whole time. How happy she was that he was that happy.
Well, and being in the Motor City, we see the cars is a big deal here, and it's so fun to see some of that stuff. And maybe classic cars or branded cars like that, but it's it's very important to many people's lives.
It is. It is. That's absolutely so very cool.
All right. Well, if you want to get a hold of us, how can they get a hold of us, John?
So you can come to the website, fsa1.com, or they can call the phone number, 800-977-9292.
Fantastic. And we have a lot of workshops, especially throughout the state of Michigan. We have webinars. Of course, those are national because as long as you have internet connection, you can get on there as well.
Absolutely.
And then we have, if you want to schedule a meeting with us, phone call, virtual meeting, come in person, wherever you want to be. You can do that through our website as well. And you can even do it directly with us. I'm Mike Wallace.
And I'm John Sauger.
Thank you for listening to the Retireable Podcast.
Investment advisory products and services are made available through FSA Advisors, FSAA, a registered investment advisor. Annuity and insurance products are offered through Financial Services of America, Financial Services of America, FSA Health Insurance Agency, doing business as FSA Insurance Agency, FSA Tax and Accounting, and FSA Advisors are commonly owned and operated by FSA Marketing Incorporated. FSAM. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. The insurance products offered by Financial Services of America FSA are not subject to investment advisory requirements. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. FSA. A is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. Chartered Retirement Planning. Counselor and CRPC are trademarks or registered service marks of the College for Financial Planning in the United States and/or other countries. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by FSAA.